Are these numbers even right? I've been playing around with a rate of return model where I'm trying to calculate what is the true rate of return in whole life insurance when we include all the benefits. This analysis will always be assumptions based, but it's also trying to understand what that metric rate of return actually means in the market. Because, first of all, I don't think it's a relevant metric. Becoming wealthy is all about increasing your income, especially passive income. That's what it's all about. Rate of return is not really a relevant metric. It's a backward looking metric. You can maybe measure how you've done in the past. And it rests on the premise that you're going to take your money, park it somewhere, and then hope that asset that you bought increases in value, which is fine. I would just call that speculating because you don't benefit from it until you generate cash flow, which means when you sell. But be that as it may, I've been playing around with this model and I'm not even sure if my numbers are right. But what I'm doing is simple. Let's start with the market and let's look at these blue columns. I'm trying to make an apples to apples comparison between the market, meaning basically the S&P 500 stocks, et cetera, your standard investments that Wall Street wants to put you in versus whole life insurance. Whole life insurance is not an investment, but this is what everyone ends up comparing it to, which is not a fair comparison. If you want to invest your money in the market, go ahead. That's fine. Now ask yourself, how much money do you want to have in cash, in savings? Where should your safe money be and how much should that be? And then move that into whole life insurance, not the money you've earmarked for investments. As you understand the benefits of whole life insurance, you'll want to put more money there because you'll understand how using whole life insurance as a volatility buffer means your investments can perform better. But let's look at this. We have to make adjustments. This contribution, let's just assume we're contributing $25,000 a year. That's an arbitrary number. You can choose whatever you want. And we have to make adjustments for all these things here. Taxes, if, when you sell, or perhaps if you buy mutual funds that are actively managed, taxes are going to be taken out. We've got to account for fees. Even low cost mutual funds or index funds have fees. What about risk and volatility? We've got to make some kind of adjustment for risk and volatility because in whole life insurance, you have neither of those. You have a guaranteed rate of return. You know your cash value is growing at a certain amount every year. We'd have to look at the risk adjusted rate of return, the volatility adjusted rate of return. Because when they say you'll get a higher rate of return in the market than in whole life insurance, that's a half truth. Yes, it's true, but what you're really saying is hypothetically, you might get a higher rate of return in the market than in a whole life insurance, or it might be worse. We know the market is going to be down some years, and in those years, whole life insurance is going to win. The market is not going to win every single year. We don't know what the market's going to perform like. We hope it's going to perform well, but we don't know. So, to make it an apples to apples comparison, we have to adjust for market risk. We can't just say you're going to get 12%. You're taking on risk and volatility. It's not going to be a smooth path up to that 12% return over the long run. If we're going to compare it to the guaranteed rate of return in whole life insurance, we have to adjust it. Return will be what return are we going to need to match the benefits we get in whole life insurance. There's quite a few things I could put in here, but I'm trying to stick to the ones that are more easy to quantify. If we're going to put money in the market, then we need to set aside money for term life insurance. This is something everybody accepts that with whole life insurance, you get a death benefit. So if you're going to make an apples to apples comparison, if I'm contributing $25,000 to a whole life insurance policy, I can't contribute $25,000 to a market based investments. I have to subtract what am I paying for term life insurance to make those two somewhat equal. So if I have $1 million in whole life insurance, then I have to take $25,000 and subtract what it would cost for me to get $1 million term policy. And this is term plus what they call living benefits. Whole life insurance will protect you in the event of long term care, a chronic or terminal illness, and in some cases, a critical illness like a heart attack, stroke, or cancer. You could earmark separate money for a long term care policy or a critical illness policy. Happily, there are new products where you can get term life insurance that also comes with living benefits. But that's the sort of term we need to purchase if we're going to apples comparison. It can't be your average term life insurance policy that doesn't cover you for long term care. It has to be term that comes with living benefits. That's what we would be paying for here. In this example, for a 35-year-old very healthy male, that would cost $2,760 annually for a 30-year term plus living benefits policy for $3 million, which is the death benefit here. We're not going to buy a separate long term care or critical illness policy. But this does not actually make it an apples to apples comparison. Why? Because that death benefit and living benefits expire after 30 years. Every term policy gives you temporary protection. Whereas with whole life insurance, that death benefit is permanent and it's guaranteed. Those living benefits don't go away after 30 years. They stay with us and they continue to grow because the death benefit continues to grow every single year. We can never make it a fully apples to apples comparison. And then creditor protection in whole life insurance, depending on your state, the cash value and the death benefit are protected from creditors, whereas your market based investments are not. I'm also going to subtract some money to buy a liability policy for, say, $1 million, which is typically the lowest that they'll give you. In this example, that costs about $450 a year. How much that costs, I need to dig into that because I'm not a PNC agent. My assumption is that would go up every single year. So saying it just costs a flat $450 every year is probably not a fair assumption. It'll probably go up at least with inflation. This term cost is locked in though, because we got a 30-year policy. And I want to point out, again, I'm being generous here to the market because most people will not buy a 30-year term policy. They'll buy a 10-year term policy because it's cheaper. And then after 10 years, who knows? They might not be insurable anymore. They might have some health issues, but assuming they can qualify now to be more expensive because they're 10 years older. So most people won't do the most efficient option of just buying a 30-year term policy. But here we're looking at what did the market do? These are the S&P 500 returns based on publicly available information. The S&P 500 returns really from the beginning, all publicly available information. In this example, we're looking at it over the last 30 years. So that means we're going from 1994, where the market was down a bit, all the way to 2023, end of 2023. And the average rate of return over that time frame is 9.67%. So that falls in line with what most people would expect when you invest in the market over the long run. 8 to 12% average rate of return over the long run. There are going to be crashes. The market crashes, meaning goes down significantly, more than 20%, about once every 7 to 10 years. There's a crash. The average rate of return is not what you actually get. An average return is not a real return. And we can go into the math on that. But these are the S&P 500 returns. I'm assuming your market-based investment is just going to track the S&P 500, which I think is a pretty fair assumption. Then here we have the whole life insurance policy. We have the term policy, the long-term care policy. Notice the long-term care policy, and it's really impossible to match, would be significantly expensive. But we're not purchasing that. And then the liability policy. If we're going to actually do this, so let's see, I need to adjust this, right? So this then becomes this, and this becomes this. In the whole life insurance policy, we can contribute the full $25,000. But in the market, we can only contribute $22,090 because we have to subtract what we're paying for term plus what we're paying for the creditor protection. So the living benefits term and the creditor protection. I'm underestimating what those would cost, honestly. So our cumulative contributions are $662,000. And from that, we end up with $2.6 million in the market. That's pretty good. Is that actually what we get? Let's back up a step. 2.6 million sounds pretty good for contributing $25,000 a year. Actually, in this case, less than that over the course of those 30 years. So far, the market doesn't look bad at all. Okay, but wait a minute. We're going to pay taxes on that. We haven't accounted for taxes. What's your tax bracket? Let's assume a 22% tax rate. That's fairly reasonable, I think. 22% tax rate. Now, all of a sudden, we just lost $1 million to taxes. 2.6 million drops to 1.6 million. And there's a significant difference there because I think most people would say you can comfortably retire on 2.6 million. 1.6 million, probably not. maybe if you have other assets. But if this is your retirement nest egg, which I wouldn't recommend putting your entire retirement nest egg in the market, it's not a smart thing to do. Can you retire 1.6 million at age 65 knowing you might have another 30 years to live? Probably not. What about fees? There are going to be fees associated with these, even if it's just an index fund. So let's assume a 1% fee. I think that's pretty reasonable. 1% fee. So that drops us down to 1.4 million. So a 9.67% return average, which that's not the real return you're getting, now drops to 1.4 million. What about risk and volatility? Again, if we're going to compare this to whole life insurance, we've got to make an adjustment for risk and volatility. Otherwise, it's not an apples to apples comparison. How much do we discount it? So let's say we're just going to discount it 1% for risk and 1% for volatility. So now we have $1 million. So after all of that, contributing $25,000 a year over 30 years, like 25,000 total, we have now $1 million net of all taxes, fees, and adjusting for risk and volatility. We paid for a living benefits term policy to give us that death benefit protection plus the living benefits. And we paid for a liability policy every year to give us the creditor protection that we would get in whole life insurance. There are other benefits that whole life insurance gives us that we're not accounting for, like the policy loan feature, the ability to borrow against the policy on a guaranteed basis without interrupting the growth in the policy. And then we adjusted for taxes. There are going to be taxes paid, fees, and then risk and volatility. All of these, of course, are assumptions. This is why I don't like getting too deep into the numbers because it's all assumptions based at the end of the day. And I'll play around with this some more. There's a lot that I'm going to potentially do with this when I have the time and the energy to put into it, because I think there can be some very powerful visuals to be created from this. But if you look at that, we've adjusted for the cost of term and living benefits and the cost of a liability policy. We've adjusted for taxes, fees, risk, and volatility. Once we make those adjustments to try to make it somewhat of an apples to apples comparison, what we find is we're left with a million point 1.05, call it 1.06 million after 30 years in a market-based account when we net all that up. Now, how does that compare to whole life insurance? And here's the whole life insurance policy. We're contributing $25,000 a year to a whole life insurance policy on a 35-year-old healthy male. And so we don't have to discount anything here. Everything you're seeing is net. All the numbers are what you see is what you get. We don't have to make an adjustment for death benefit or long-term care protection or risk or volatility or taxes. No taxes are paid on any of this. There is no risk or volatility because the cash value growth and death benefit growth in the policy are guaranteed. It comes with long-term care protection, terminal illness protection, and creditor protection. So we don't have to make the same adjustments. We contribute $25,000 for 30 years, and then we get to age 65. Notice we pay no more premiums. I don't recommend this, but I like illustrating it to show that a whole life insurance policy can be fully paid up. It also eliminates more moving parts, more variables, so it becomes easier to see what's going on when we use whole life insurance to generate income in retirement. We're not going to get into that for the purposes of this exercise, but just showing you where we end up. So remember, in the market, we had 1.06 million in market-based assets after we accounted for taxes, fees, risk, and volatility, paying for term life insurance with living benefits and a liability policy. And that still, in my opinion, doesn't make an apples to apples comparison. We're still being generous to the market. We're not accounting for, as an example, the policy loan feature. With whole life insurance, we can borrow against the policy without taking on debt. It's a guaranteed contractual right. And when we borrow against the policy, we're not interrupting any of the growth in the policy. But be that as it may, here we end up with $1.7 million in cash value. So we had 1.06 million in the market. Here we have 1.7 million in cash value, not to mention a $2.9 million death benefit. With that term, with the living benefits, that expires. So that term policy would expire at this point and we would have no death benefit. We would just have the $1 million in market-based assets. Here, the death benefit does not expire. In fact, it keeps growing, and so does the cash value. So we end up with 1.7 million as opposed to 1 million, not to mention a $3 million permanent death benefit that will continue to protect us in retirement from a potential long-term care event or a terminal illness, or in some cases, even a critical illness like a heart attack, stroke, or cancer. In this example, once we make the appropriate adjustments, we see that the net value at the end of the day you get in whole life insurance is substantially more than what you're getting from market based assets. We can also show in another video potentially how not only is this 1.7 million in cash value more than a 1.06 million you have in market based assets, we can get more out of it because with a seasoned whole life insurance policy, we can start using the policy loan feature to borrow against the policy and generate, in this example, $72,000 of income every year. And no taxes will be paid on that because a policy loan is not a taxable event. And we can do that for 20 years in retirement, $72,000 a year for 20 years. And after that, we have more cash value than we started with. We now have 2.1 million in cash value rather than 1.7. And that's just showing you the net cash value. Similar to the net equity you have available to you in your house, the total value of your house keeps going up. And that same roughly $2.9 million death benefit, we also have that. So after taking all that income out of the policy, we have more in the policy than we started with. That's just to show that not only is the total value more, but you can actually get more out of it because of the policy loan feature, our ability to borrow against the policy without taking on debt and without interrupting anything we're earning in the policy. What rate of return are we actually getting in the market? In this example, it's the equivalent of contributing $25,000 a year. We actually contributed less, but that's so we can equalize for what we're getting in whole life insurance. So let's look at this. If we're contributing $25,000 a year, that is approximately 2,083 a month. We'll say 2,083.33. And we start with 25,000. That's the first. We don't need to worry about inflation. So we'll just say zero. And we're doing that for 30 years. Okay. And we end up, remember, we end up with 1.06 million, right? So we're looking at this number here. We can say pre-tax because we've accounted for everything, taxes and everything like that. And we ended up with 1.058 million. So about 2%. That's what we're saying. Effectively, in the market, after all of that, we're getting about a 2% rate of return when we compare it with whole life insurance because we had to discount for all the other benefits we're getting. So the actual rate of return net of all the issues we're talking about is actually 2%. This number right here, 2%. 2%. That's what we're actually getting net. And that gets us a little bit more than what we ended up with, but effectively what we end up with, again, after we adjust for the cost of term and living benefits, the cost of a liability policy, taxes, fees, risk, and volatility. Now, what rate of return would we actually really need to get in order to match what we're getting in whole life insurance? In whole life insurance, we ended up with 1.7 million in cash value. This rate of return actually wouldn't match the benefits we're getting in whole life insurance. It would only match the cash value. But let's go ahead and see what we would need. So we're trying to get 1.7. Let's see what we would need to get, and would actually need to be. This would be the net rate of return. The gross rate of return would actually need to be higher. So let's look at 4. Okay, that doesn't do it. 5. Okay, 5 does it. Let's see, 4.8. Yeah, so in whole life, we end up with about 1.72 million. So let's see, 4.9, 0.85. There we go. About 4.85, roughly. In fact, if we wanted to get even more granular, call it 4.84. But that's a net rate of return. So a 4.84% net rate of return. That's what we're getting on our cash value in the life insurance policy. That's pretty good when you consider everything we're getting. So close to 5% over the long run, net of fees, taxes, everything. That's pretty darn good. We're not even accounting for the death benefit. So the net rate of return, let's see, would obviously be more than that. We'd have to account, I'm guessing it would be, I don't know, 15 or something. I'd have to calculate that. So we need to get a 4.84% net rate of return after accounting for all of those things. So what would that gross rate of return be? I'll have to try and calculate that separately. So here's another thing. We said the average rate of return of the market over those 30 years was 9.67%. When we looked at the rate of return model, when we didn't subtract anything, we didn't adjust for inflation or taxes, we didn't adjust for anything, we just left it straight up. Remember, we didn't have 4.2 million. Here, this calculator is telling us if you contribute $25,000 a year, a little under 2,100 monthly, and you make a 9.67% interest rate on that money over 30 years, you should have 4.2 million. That's really good. But wait a minute, we didn't have 4.2 million. We only had 2.6 million. So is my math wrong? Is my math wrong? Actually, no, my math is correct because an average rate of return is not a real rate of return. If you made 9.67% every single year in the market over 30 years, you would end up with 4.2 million. But in this case, we didn't make 9.6% every year. We had an average rate of return of 9.67%. But because of what we called the sequence of returns risk, I actually end up with less. I actually end up with, let's see, it was 2.6 million. Zero these out. And let's zero out that. Okay. I'm sorry, 2.9 million, excuse me. Yeah. That's without even accounting for the cost of term or anything like that. I'm contributing the full 25,000 every year. We're not accounting for the cost of term at the moment. We're just looking at straight up numbers. I end up with 2.9 million instead of 4.26 million, instead of 4.3 million. Why is that? Because of the sequence of returns risk. So, what's the real rate of return, not the average rate of return? 9.67% is the average rate of return. What's the real rate of return? Let's back into it. So we end up with 2.9 million. So what would that equate to in terms of rate of return? Let's see, 7.8. About 7 point, I'm trying to match it exactly, but yeah, about 7.74%. So the average rate of return is 9.67%, but the real rate of return is 7.74%. And if we go back, that means instead of 4.2 million, we have 2.9 million. So we lost $1.3 million. We got $1.3 million less than what we were expecting, significantly less. That's like over 30% less than what we were expecting. That's a big deal. So when they advertise that the S&P 500 averages 9.67%, understand your rate of return is going to be different because of when those returns happen. And perhaps in the future, I'll illustrate an example that'll really dramatically show this, where if we average it out over those 30 years, but the last year, the 30th year is when the market crashes, you're going to have maybe a negative or flat rate of return over that entire time frame, right? If you started investing 30 years prior to 2008 and then you stopped in 2008, you might not have made any money on net over those 30 years. Now you got to wait for the market to recover. That just shows you the difference between an average rate of return and a real rate of return. So here, the difference between the average rate of return of 9.67%, which you thought you were getting, and what you actually got, the real rate of return, the CAGR, if you will, compound annual growth rate, was 7.74, which means you lost $1.3 million. You lost about a third of your nest egg that you thought you were getting. And that's not accounting for taxes, fees, the cost of term life insurance with living benefits, the cost of liability protection, risk, and volatility. So the headline advertised numbers are average or gross numbers, which don't equate to what you actually get in reality.